You saw the market fall, you blamed IT, you blamed oil, but what if that is not the real reason? What if the real pressure is invisible? Tell me honestly, are you tracking foreign money? Just the red candles. Now, that's the difference between reacting and understanding. Because markets don't just fall on news, they fall when liquidity shifts. And by the end of this video, you will understand whether foreign investors are quietly reducing the exposure or not, why dollar returns matter more than rupee returns, how FI flows amplify the volatility, and what happens if they continue exiting. Stay till the final section. That is where the real risk scenario unfolds. So, first of all, why does the foreign money matter? Now, foreign institutional investors hold large proportions of IT, financials, large cap index stocks. When they buy, indices rise fast. When they sell, pressure compounds. Retail investors don't move indices. Liquidity does. And foreign capital is liquidity. Now, here is the important part. Foreign investors measure returns in dollars, not rupee. If the rupee weakens, their dollar returns shrink, even if stock price doesn't crash. Now, that changes the behavior. So, what is the currency layer most people ignore? If the USD strengthens globally, emerging markets feel the pressure. If rupee weakens, foreign investors face double risk: liquidity volatility and currency depreciation. So, they reduce the exposure. Not because India is broken, but because capital reallocates globally. Money flows where risk adjusted return improves. That is mechanical, not emotional. And mechanical selling is persistent. So, why does it feel different? When FI selling coincides with IT weakness, bank hesitation, broad sector pressure, that signals liquidity reduction. Liquidity reduction increases the correlation. Correlation increases the volatility. Volatility increases the fear. Fear accelerates the outflows. See the loop? Liquidity, it leads to affecting the volatility, that affects the fear, and that affects the more liquidity exit. Now, that's the dangerous cycle. So, is this a structural exit? Now, there's an important distinction. Short-term FI selling is normal, but sustained outflows signal capital rotation. So, we should watch the dollar index trend, US bond yields, emerging market ETF flows, rupee stability. If US yields rise and dollar strengthens, emerging markets face the headwinds. If dollar cools and flows stabilize, this is global capital chess, not daily panic. So, what happens if they continue selling? If FI selling persists, large caps stay under pressure, valuations compress, short term rallies fade faster, breadth weakens. But here's the flip side: when selling exhausts, sharp rallies follow because liquidities return fast. What is the key? Timing flow reversal, not predicting headlines. If you are serious about investing, stop obsessing over daily price. Start tracking the liquidity because price reacts to flow and flow reacts to global capital shift. Most investors watch the candles, few watch the capital. If you want to understand markets at that level, subscribe because smart money moves first and price follows later.